Welcome to the September 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by MAV. Federal Reserve Policy and Economic Assessment. MAV analysed the September Federal Open Market Committee decision, highlighting a 25 basis point rate cut that met market expectations but revealed underlying policy tensions. The decision demonstrated limited dissent, with newly appointed Governor Stephen Moran being the sole advocate for a larger 50 basis point reduction. MAV expressed concern that this represents a policy error, arguing the economy demonstrates insufficient weakness to justify rate cuts. The Federal Reserve's dot plot indicates 2 additional rate cuts planned for the current year, with median projections targeting total personal consumption expenditure inflation at 3% by year-end, declining to 2.6% in 2026 and 2.1% in 2027. MAV characterized the 2027 projection as unlikely given current economic momentum, falling interest rates, and rising inflation. The committee discussed the Fed's emphasis shift towards labor market concerns over inflation targets. Chair Powell acknowledged that labor market weakness stems partly from migration and population growth changes rather than fundamental demand deterioration. The break-even employment rate, previously estimated at 100,000 to 150,000 monthly job additions during peak population growth, has declined to approximately 75,000 according to Goldman Sachs estimates, with MAV suggesting it could be as low as 0 to 50,000 monthly. Recent 4-month average job creation of 27,000 monthly appears consistent with reduced labour supply rather than demand-driven economic weakness. Labour market dynamics and data revisions. Comprehensive analysis of labour market indicators revealed structural changes rather than cyclical deterioration. The Bureau of Labour Statistics announced preliminary revisions removing 913,000 jobs for the 12-month period ending March 31st, reflecting population model adjustments. This substantial revision supports the thesis that apparent labour market weakness reflects supply-side changes rather than demand collapse. The Establishment Survey shows declining employment growth whilst the Household Survey demonstrates falling participation rates, explaining why unemployment rates haven't increased proportionally to reduced job creation. The unemployment rate currently stands at 4.3%, with Federal Reserve projections indicating an increase to 4.5% by year-end. Initial jobless claims have climbed to a 4-week moving average of 240,000. with MAV identifying 300,000 as a critical threshold indicating genuine labour market deterioration. The SARM rule reading remains well below the 0.5 recession indicator level, suggesting labour supply reduction roughly matches labour demand reduction, maintaining market equilibrium. This data challenges the Federal Reserve's assessment of labour market weakness, requiring monetary accommodation. Inflation trends and monetary policy implications. Current inflation dynamics present concerning divergence from Federal Reserve policy direction. Year-on-year consumer price index inflation has increased from 2.4% at the time of the first rate cut 12 months prior to 2.9% in August 2025, whilst monetary policy has become increasingly accommodative. Seasonally adjusted annualized inflation rates for both headline and core CPI measures have reached mid-3% ranges, indicating upward price pressures. This trajectory suggests potential abandonment of the 2% inflation target in favour of labour market priorities. MAV identified potential for pseudo-stagflation scenarios. Though not comparable to 1970s conditions without additional supply shocks such as energy disruptions or supply-disabling infrastructure failures. The combination of ongoing economic growth, above-target inflation, and loosening monetary policy creates conditions for sustained price pressures. Real interest rates, measured through Treasury inflation-protected securities, have declined significantly, with 10-year real rates falling to approximately 1.7% from levels well above 2% previously. This decline in real borrowing costs may exacerbate inflationary pressures whilst the Federal Reserve continues rate reduction policies. Economic growth and market implications. Comprehensive review of economic indicators contradicts Federal Reserve weakness assessments. Capacity utilization remains stable. Core capital expenditures continue growing, and retail sales demonstrate strength in both nominal and inflation-adjusted terms. GDP nowcasting models indicate third-quarter growth tracking at 3.3% according to the Federal Reserve Bank of Atlanta, with alternative measures approaching 3%. The New York Federal Reserve's weekly economic index accelerated to 2.24% YYY from approximately 2% YY at the second quarter's end, indicating economic momentum rather than deceleration. Estimated domestic final demand shows consumer spending brought forward ahead of potential tariff implementations, followed by temporary weakness and subsequent rebound. Private investment remains solid after a period of softness, with housing representing the primary weakness sector due to elevated long-term interest rates and construction costs. Inventory adjustments have influenced GDP calculations, but underlying demand remains robust. Stephen and Kingsley highlighted the artificial intelligence sector's continued expansion potential, noting shorter data center construction lead times compared to semiconductor manufacturing, supporting a potential melt-up scenario in risk assets despite concerns about long-term bond market responses to excessive monetary accommodation. There was less time available to discuss the Australian macro environment in detail, but the presentation pack features the latest GDP analysis and updated charts. These confirmed MAV's view in recent months that activity had picked up and was already responding to the RBA's rate-cutting cycle. Per capita GDP had again turned positive, while the saving rate stayed above 4%. Ausbil Australian Large Cap Equities Earnings Season Review. Market volatility and structural changes in equity trading. The August 2024 reporting season exhibited unprecedented volatility, with Nick Condolian noting it represented the most volatile reporting season on record, a claim corroborated by major investment bank analyses. This volatility was characterized by large capitalization stocks displaying behavior typically associated with small cap equities during earnings announcements. Condolian attributed this phenomenon to increased activity from quantitative funds, hedge funds, passive ETF funds, and artificial intelligence-driven trading platforms that respond immediately to keywords and phrases during earnings calls. These algorithmic systems interpret singular words from company executives, often incorrectly, triggering automated buy or sell orders that create cascading effects as passive funds recalibrate to benchmark movements. The presenter observed real-time share price reactions during earnings calls that corresponded directly to specific commentary, demonstrating the immediate impact of AI-driven trading on market dynamics. This structural shift represents a permanent feature of equity markets rather than a temporary anomaly, requiring both active managers and corporate management teams to adapt their strategies accordingly. Companies are now compelled to carefully script both written materials and verbal communications during earnings calls to manage algorithmic responses, creating an adversarial dynamic between corporate communications and AI interpretation systems, earnings performance and market positioning. The August full-year reporting season demonstrated corporate resilience with 33% of companies delivering earnings beats compared to 22% experiencing disappointments, creating an 11% positive differential that Condolian characterized as healthy. This performance occurred despite challenging macroeconomic conditions, including high inflation, elevated interest rates, and geopolitical uncertainties. The earnings surprise data, sourced from Macquarie, showed improvement from the February reporting season for December results, where inline results predominated. The positive earnings surprise trend suggests potential for continued equity market momentum over the subsequent 6 months, as beats typically translate into positive earnings revisions and price-to-earnings expansion. Condolian emphasized that companies achieving positive surprises demonstrated superior top-line performance through better demand environments, improved pricing power, and most critically, enhanced cost management capabilities developed during the inflationary period. This cost discipline has become embedded in corporate operations, enabling companies to maintain margins and deliver robust earnings despite ongoing economic uncertainties. Sector performance and geographic exposure disparities. The reporting season revealed significant sectoral and geographic exposure disparities, with Australian retail environments demonstrating unexpected strength despite prevailing negative sentiment regarding cost of living pressures. Materials sector performance was particularly strong, rising 12% and leading value stock outperformance during August. Small capitalisation stocks significantly outperformed large caps, whilst growth stocks, particularly technology, underperformed after extended periods of outperformance and elevated expectations. Healthcare emerged as a significant disappointment, led by CSL's poor performance, with the sector experiencing negative sentiment due to US healthcare policy changes under new regulatory frameworks. Real estate investment trusts benefited from lower interest rate expectations, with the US Federal Reserve implementing a 25 basis point cut and signalling at least 2 additional reductions. Companies with substantial US exposure, including James Hardie, Reece, CSL, and BlueScope Steel, faced particular challenges due to weak American consumer environments and structural headwinds. Conversely, domestically focused companies generally outperformed, supporting the thesis that Australian economic fundamentals remain relatively robust compared to international markets. Capital returns and valuation implications. The reporting season delivered positive surprises regarding capital returns to shareholders, with companies implementing increased dividends, special dividends, and share buyback programs above historical levels. Companies also elevated payout ratios, reflecting confidence in earnings sustainability and balance sheet strength. This capital return enhancement was facilitated by the same factors driving earnings beats: improved demand conditions, pricing discipline, and particularly effective cost management. Despite positive earnings performance during the reporting season, fiscal 2026 earnings expectations were revised downward, consistent with typical post-reporting season patterns where consensus estimates prove initially optimistic. This downward revision, whilst not material, resulted in market valuation expansion as equity prices rose whilst forward earnings estimates declined. Condolian acknowledged current market valuations sit at the expensive end of historical ranges, but justified this premium through the lower interest rate environment and robust corporate earnings foundations. The presenter expressed confidence that the setup supports continued earnings beats in future reporting periods, potentially driving further valuation expansion despite already elevated multiples. The combination of lower inflation, declining interest rates, and demonstrated corporate earnings resilience creates conditions supportive of current valuations and potential further appreciation. Cromwell Property Group, Ariet's earnings season. Briefing. Interest rate environment and sectoral impact. Stuart Cartledge emphasised the substantial interest rate sensitivity inherent within the property sector, noting the sector's prolonged exposure to aggressive rate hiking cycles that disproportionately affected property performance relative to other asset classes. Cartledge characterised the current environment as a turning point, employing an analogy of having completed a challenging headwind phase and now benefiting from tailwind conditions with anticipated interest rate reductions. Cartledge indicated that lower interest rates would provide dual benefits: supporting property valuations through improved relative valuation metrics against cash and bond rates, and enhancing income growth through reduced debt servicing costs. Property trusts typically maintain approximately 30% debt-to-assets ratios, making earnings particularly sensitive to interest rate movements. Cartledge cited Waypoint REIT as an exemplar, noting that interest rate costs represent virtually the only variable affecting earnings for assets with long-term lease structures, questioning the entity's decision not to secure longer-term fixed-rate financing despite the additional cost implications from yield curve positioning. Capitalisation rates and valuation metrics. Analysis of capitalisation rate movements across property subsectors indicated stabilisation following a period of sustained upward pressure. Cartledge observed that cap rates had remained essentially stable over the preceding 6 months, with some subsectors experiencing modest contraction, contrasting sharply with the preceding 2-year period of declining capital values. Cartledge noted cap rates had returned to pre-COVID levels, suggesting diminished concerns regarding continued valuation deterioration. Cartledge distinguished between the methodologies employed by independent valuers versus listed market pricing mechanisms, describing valuers as inherently backward-looking due to their reliance on transactional evidence, whilst characterizing listed markets as forward-looking in their pricing approach. The valuation process involves external independent valuers conducting periodic assessments for both listed and unlisted property trusts, with cap rate determinations influenced by available transactional evidence. During periods of limited transaction activity, valuers necessarily rely more heavily on historical data points, potentially creating temporal lags in valuation adjustments. Supply-demand dynamics across property sectors. Significant supply constraints emerged as a dominant theme across retail, industrial, and office property sectors. Jones' Lang-LaSalle analysis revealed material reductions in additional retail space rollout compared to population growth rates, with historical parity between space addition and population growth being disrupted. Regional shopping centres exhibited particularly pronounced supply constraints, with Cartledge noting the absence of new regional centre developments, citing Rouse Hill as potentially the most recent significant addition. The presenter indicated planning and zoning processes create substantial lead times, providing reasonable certainty regarding supply pipelines through 2027 to 2028. Industrial property demonstrated similar constraints, with current market rents remaining below economic rents required for development viability across various submarkets. Construction cost inflation was identified as a primary factor constraining new development activity. Office supply analysis focused on Sydney CBD revealed materially below average supply pipelines, with major developments including Atlassian Central, Dex's, 100% pre-leased, 55 Pitt Street, Miravac, approximately 30% pre-committed, and Chifley South, Charter Hall, representing the principal near-term additions. Cartledge noted these developments would likely achieve minimal development margins given current market conditions. Market pricing and performance outlook. Listed property pricing analysis utilised GPT as a sector proxy due to its balanced exposure across office, industrial, and retail assets. Historical price-to-book relationships demonstrated prolonged periods of share price trading below net tangible asset values since COVID, with recent weeks marking a return to marginal premiums. Current individual stock analysis revealed trading discounts ranging from 0 to 25% to book value, excluding active management entities such as Goodman Group and Charter Hall Group, which trade at substantial premiums due to their development and funds management activities. Cartledge anticipated continued stabilisation in cap rates combined with improved rental growth prospects, driven by undersupplied markets and adequate business conditions. The presenter expressed confidence in the sector's positioning for outperforming market expectations regarding rental growth, potentially leading to valuation improvements even in stable cap rate environments. Should cap rate compression occur, valuation improvements would accelerate materially. The reporting season was characterised as notably upbeat relative to recent periods, with strong outlook conditions expected to gradually influence market pricing mechanisms as rental growth exceeds current market expectations. Discussion. Economics. The committee conducted an extensive analysis of current market conditions based on insights from the reporting season presentations. Mav noted the differentiation between market performance and economic fundamentals, commenting that the economy is not the market. Hence, while the domestic economy had shown periods of weakness over the last 12 months, earnings per share improvements were being driven by domestic earners, now supported by the interest rate cutting cycle. The committee observed that this dynamic represented a notable shift from previous periods where globally focused companies had outperformed their domestic counterparts. The committee examined the reporting season outcomes in detail, with particular attention to the volatility in market reactions despite generally positive earnings results. Members noted the increased dispersion between individual stocks within sectors, moving away from traditional sector-based trading patterns. This was identified as creating a more stock-specific market environment that favoured active management approaches. The committee also discussed the PE expansion occurring across the market, with valuations becoming stretched even beyond the supportive interest rate environment. Significant attention was given to domestic listed property sector dynamics, with the committee noting the structural support from supply constraints, rising construction costs, and population growth. Members observed that property valuations had returned to pre-COVID levels while maintaining attractive characteristics as inflation hedges. The committee noted the differentiation within property markets, particularly between prime CBD locations and peripheral areas, and the ongoing impact of infrastructure developments on relative positioning. The committee also reflected on the broader global context, acknowledging the resilience of both US and Chinese economies. This was seen as supporting the view that current market conditions could persist longer than initially anticipated, though members remained conscious of stretched valuations across most asset classes. Portfolio construction. The committee undertook a comprehensive review of portfolio positioning and agreed to several tactical adjustments. The growth-defensive allocation was adjusted from the neutral 60%/40% SAA position to a 63%/37% split, reflecting increased confidence in growth assets given the interest rate cutting cycle and absence of immediate recession risks. This is not to say that a market correction cannot happen in the nearer term, rather, that is exceedingly difficult to time, and hence the committee is looking beyond this. MAV led discussion on rebalancing the equity allocation, with the committee agreeing to reduce the underweight position in Australian equities by deploying 2% from cash reserves, while 1% from the FRNS, floating rate notes, funded a larger position into Australian small caps. This decision was supported by the prospect of rate cuts being more beneficial to Australian small caps, in addition to the improved domestic earnings momentum identified during the reporting season analysis. The committee implemented a significant tactical adjustment to its global equity exposure, introducing a 4% allocation to hedged global equities while maintaining the overall global equity weighting. This represented 20% of the large-cap global exposure being hedged, reflecting concerns about Australian dollar strength given interest rate differentials and commodity price dynamics. Members agreed this provided optionality to alter hedging ratios if the Australian dollar moved above 70 cents. The committee expressed satisfaction with recent positioning decisions, noting that the increased allocation to AREITS, movement into high-quality credit, and overweight position in global small caps had contributed positively to performance. The overall portfolio remained slightly overweight global assets through the small cap allocation, while the new hedging strategy provided protection against potential currency appreciation without requiring a reduction in growth asset exposure.